Yeah, I think one of the easiest ways to learn something new is to compare it to something you already know. Do a little compare contrast. Then you get an idea of the similarities, the differences, the pros and cons. So if I'm teaching a stock trader about the basics of buying a call option, I'm gonna prepare some visuals, right? So I love to do a risk graph and compare the risk graph of long stock versus long call. I really think that this makes some impact here. So let's say we're comparing somebody who buys stock, okay? And if I look at the usual risk graph, got an X and a Y axis. The graph of a long stock trade is a 45-degree line. And remember that when you're above the line, you're making money. So this is like the amount of gain. And when you're below the line, you're losing money, okay? And the vertical axis, this would be like profit. This would be loss. And then down at the bottom, you have the stock price. So let's say we buy a $50 stock, right? We buy $50 stock. So 50 bucks, that's going to be the break even. So that would be 50 on the chart. And then if you get up towards 60 or 70, you know, you're making money, right? And then if you go down towards like 40, you're going to be losing money. So you've got 40, 50, and 60 down there at the bottom. Well, think about the appeal of buying a stock. The appeal is you have unlimited upside, right? And you think, oh, you know, stock's not going to go to infinity. True, but you know, look at a long-term investor in Apple and some of these really, really big companies. They've made tons of money, right? Hundreds and hundreds, maybe thousands of % return. We like the unlimited upside nature of the stock market. What we don't like as much is that the stock could go to zero. You could lose all your money. So the risk is open-ended, at least until you get to zero, right? I hate putting the infinity sign here, but really your risk. So this was your profit. So your risk is, I'm going to say open-ended. Okay, open-ended. It's effectively unlimited until you hit zero, which means it's limited, but it's open-ended. It's open-ended. And that is the scary part of owning a stock. You don't know how bad it's going to get. Think about what happened a week ago, 2 weeks ago, 3 weeks ago. S&P was down, 7, 8, 9, 10%. The Russell was down 20, 22%. Every time the market does that, it's like, okay, we're going to go down twice as much, 3 times as much. Like, is this the big one? And you freak out because your risk is open-ended when you own equity. Well, I want a better mousetrap. I want the upside, but I don't want the downside. Can I create a trade, a strategy that's like stock in the sense that I have the open upside, but not like stock in the sense that I can dodge the open-ended downside? Well, that's effectively what a call option does. So when you buy a call option, okay, the shape of the risk graph, which tells you the risk and reward characteristics, is different. It starts kind of like long stock. If the stock cooperates and it goes up, you have similar upside. You have similar upside. This looks like this, okay? Specifically, let's say I buy not the stock at 50, but let's say I buy a 50 call option and I buy a 50 strike call. And maybe that costs me, $4. Well, when you buy a call, you have the right to buy stock. It's a contract that gives you the right to buy stock. And because you've locked in the right to buy the stock at, in this case, 50, okay, that's the price at which you have the right to buy stock. If stock goes to $1 million, you can exercise your contract, buy the stock at 50 and sell it at $1 million and make a ton of money. And so a contract that gives you the right to buy stock is going to move like stock because you can convert it to stock. So the upside is similar. I like that piece. So profit, okay, profit essentially is unlimited, open-ended. Okay, but here's kind of the nice piece. What if the stock goes down, right? So this would be like the stock at 50, running up to 60. What if the stock goes down to 40? Well, if I own the stock, I've got all that downside. With a call option, you didn't have to pay all that money yet. you only had to pay for the call option. So the risk is what you paid. In this case, $4. This $50 stock could go to zero. Worst case, contract expires and I lose what I paid, which was $4, not 50. And so the downside is capped. Once you lose your $4, you can't lose anymore. And so look at the risk side of the equation here. Look at the risk side of the equation. Open-ended risk, okay, essentially the whole $50 I paid. Here you have limited risk to $4. Well, dude, all else equal, I like the chart on the right. I like the chart on the right. It's a limited risk, a lower cost way of building a position, kind of like long stock. And so when we talk about this being a directional trade, this is not a cash flow play. It's more of a directional play because it gives you a graph kind of like stock. And when you buy stock, it's not a cash flow play. It's a directional play. I want the stock to go up. I buy a call. I want the stock to go up. So we view long calls as a substitute to buying stock. And if you just compare the risk graph here, it seems like you'd be an idiot not to buy a call option. Why in the world would you opt for open-ended upside but open-ended downside when you could have open-ended upside with limited downside? Well, there's a catch. You don't get something for nothing. What makes call options a little bit harder to make money with, a little bit more challenging than long stock, is the fact that you have to pay for time and the expectation that in that time, the stock's going to move, which we call volatility. And that essentially means that the stock has to go up a little bit to break even when you buy a call option. So with stock, my break even, if I buy a stock at 50, is $50. If I buy a stock, as soon as it goes up a penny, I make money. So that break even right here, this is the break even, is right at $50. You have a 50-50% chance, right? You got a coin flip odds when you buy stock. Well, it's not that you thought 50-50 was good odds anyways, but I'm telling you, it's not even that good. It's worse when you buy a call. I paid $4 for this call option, this 50 strike call. Guess what? My break even at expiration is $54. So your break even is 54 at expiration for the long call. It's only 50 for the stock, which tells you buying a call has worse odds. I don't just need the stock to go up to make money on a call. I need it to go up far enough, fast enough, because these have expiration dates. That far enough, fast enough piece is the catch with buying a call option. And it's why it's more challenging to make money buying calls than buying stock. And it's, that's the con. Okay. It's not unsurmountable or insurmountable. It doesn't mean that it can't be worth it, but you got to go into this with both eyes wide open. Okay. So if you want less risk, but similar upside to long stock, and you're willing to have a little bit worse odds, long call can be a very interesting play. I'll hasten to add that if you don't ride all the way to expiration, the break even's better. Okay. Your break even over the first few days is going to be similar to the break even with stock. It's just that the longer you're in the call option, the more the stock has to move to offset what we call time decay, which is that option losing value as time passes. Okay. So conceptually, that's long stock versus long call. Let's look at a quick example. So Matt and I were looking at a couple stocks here before the class today. A&F was one, Abercrombie and Fitch, trying to make a nice little turnaround coming into a gap area. The other one was Qualtrics. Qualtrics getting above the 50-day moving average today, trying to push higher. I don't have an opinion, a strong opinion on those two. I'm just going to go with Abercrombie and Fitch here. But I want to compare buying the stock to buying a call option. So stock's $40.80. If I bought 100 shares, it'd be about $4,000. Kind of expensive, $4,000. So instead, I'm going to see if maybe I can take a tenth of that, maybe $400 or less, and buy a call option instead. So I'm going to go to the trade tab, and I've got lots of months to choose from here. Okay, I'm going to go ahead and see if we can buy April call option. If I buy the 40 strike, which is kind of at the money, it's going to cost me about $4.30. So let's just go with that for a second. Let's assume I can get filled at $4.30. Let's analyze the trade. And here's the risk graph. The blue line is what I drew on the blackboard a second ago. That's the expiration risk graph. Look at the similarities. My risk limited to $430. Doesn't matter if A&F goes bankrupt. Can't lose more than what I paid. I like that part of the long call. My upside, unlimited. It can go up as much as it wants, and I have open-ended profit potential here. The catch is that break even. My break even at expiration is not $40. Stock currently is at $40.80. It's my break even today. Okay. But as time passes, it's going to get closer and closer to $44.30. So the frustrating part about long calls sometimes is if you overstay your welcome, the stock can go up and you still lose money. That would never happen with long stock. Okay. It would never happen with long stock. Stock goes up a penny, you're good. Long calls, I need it to go up far enough, fast enough. But if it does go up far enough, fast enough, you got a really high return based on the leverage component. But let me leave it at that. Little short version here on the long call. Those are the benefits. That's the comparison versus long stock. And you can use it as a substitute when you want to go a little more aggressive on those directional plays.